Are you planning to invest your hard-earned money? Before you dive into the world of stocks and bonds, ask yourself, are you aware of the common pitfalls that can jeopardize your investments? In this video, we will explore the wisdom of two legendary investors, Warren Buffett and Charlie Munger. These names are associated with success in the world of finance, and for good reason. So let's get started. Number 10. Overtrading and frequent portfolio changes. Overtrading is a behavior that Buffett and Munger strongly caution against. It occurs when investors excessively buy and sell securities within a short time frame, often reacting to market noise and short-term price fluctuations. The primary issue with overtrading is that it incurs substantial transaction costs such as brokerage fees and taxes, which can significantly eat into an investor's returns. Moreover, this frequent trading tends to be driven by emotions like fear and greed rather than rational analysis. To illustrate, imagine an investor who constantly buys and sells stocks based on daily market movements. They might incur substantial expenses in the form of commissions, bid-ask spreads, and capital gains taxes. In contrast, long-term investors who hold their positions for years or decades can benefit from compounding returns and reduced transaction costs.
The biggest thing in making money is time, and I've had this long run, and so the compounding at the end turns into very big numbers. But you've got a tailwind in this country if you just own a cross-section.
Warren Buffett and Charlie Munger advocate for a buy and hold strategy, often referred to as investing for the long haul. They recommend identifying high-quality businesses with strong competitive advantages and holding on to them for an extended period, allowing time for the business to grow and generate wealth. This patient approach aligns with their belief in the power of compounding, which is a cornerstone of their successful investment philosophy. Number 9. Failure to understand the businesses they invest in. Another critical mistake that investors frequently make is investing in companies they don't fully understand. Warren Buffett and Charlie Munger emphasize the importance of having a deep comprehension of the businesses in which you invest. This understanding involves more than just reading annual reports or financial statements. It requires an in-depth knowledge of the industry, competitive landscape, and the company's management. For instance, if an investor buys shares in a technology company without grasping the nuances of the tech sector or the specific challenges the company faces, they are at a higher risk of making uninformed decisions. This lack of understanding can lead to panic selling during market downturns or missing opportunities to buy more shares when the company's fundamentals remain strong. Buffett and Munger encourage investors to stay within their circle of competence. This means focusing on industries and companies that align with their expertise and knowledge. By doing so, investors can make more informed judgments about a company's potential for long-term success and avoid investments driven purely by speculation or market trends.
But the advice I would give is to read everything in sight, and to start very young. It's a huge advantage in almost any field to start young, and if that's where your interest lies, and you start young and you read a lot, you're going to do well. I mean, there are no secrets in this business that only the priesthood knows. I mean,
Number 8. Market timing and speculation. Attempting to time the market and engaging in speculative trading is a common pitfall that Buffett and Munger strongly discourage. Market timing involves trying to predict when stock prices will rise or fall and making investment decisions based on those predictions. However, accurately forecasting short-term market movements is exceedingly challenging, even for seasoned professionals. Market timing is a risky strategy because it requires not only the ability to predict when to buy, but also when to sell. Investors who attempt this often find themselves selling low during market downturns and buying high during market euphoria, leading to suboptimal returns. In contrast, Warren Buffett and Charlie Munger advocate for a simple yet effective investment strategy, buying quality companies at reasonable prices and holding them for the long term.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
They believe that trying to time the market is futile and that it's better to focus on the intrinsic value of the businesses you invest in. This approach allows investors to benefit from the long-term growth potential of solid companies, regardless of short-term market fluctuations. Number 7. Neglecting risk management. Neglecting risk management is a mistake that often goes unnoticed until it's too late. Investors frequently focus on potential returns while overlooking the importance of preserving capital and protecting against potential losses. Warren Buffett and Charlie Munger emphasize that avoiding significant losses is crucial because it can take substantial gains to recover from steep declines. To mitigate risks, investors should conduct a comprehensive risk assessment before making any investment decisions.
That's a risk we run. We run a risk that, in terms of terrorists doing a lot of things but we're in the business of taking risks, and we try to get paid appropriately.
Well, as we finish up, that is the story of the day, is risk, and how the president doesn't want financial institutions taking risks. So as we finish up, what's your final thought on that?
Well, I tell people, and it's going to be in the annual report again this year, when you have a company as large as Berkshire and with all the obligations we have to paraplegics that have been injured and we're going to have to pay for 50 years, to all the employees we have, all the stockholders we have, I have to be the chief risk officer.
Diversification, a strategy frequently employed by Buffett and Munger, involves spreading investments across various asset classes and industries. This diversification helps reduce the impact of a downturn in any single investment or sector. Additionally, Buffett and Munger advise against investing in assets or businesses that are too complex or difficult to assess. Complex financial instruments or companies with opaque financial statements can hide hidden risks that investors might not fully understand until it's too late. Number 6. Chasing hot trends. One frequent pitfall for investors is chasing hot trends and fads. Many investors are tempted to jump on the bandwagon of the latest investment craze, whether it's a popular tech stock, cryptocurrency, or a particular industry sector. This behavior often leads to buying assets at inflated prices and can result in significant losses when the trend inevitably cools off. Buffett and Munger caution against this herd mentality and advise investors to maintain discipline and stick to their investment principles. Instead of chasing the latest trend, they recommend focusing on the fundamental value of an investment and its long-term prospects. By avoiding speculative bubbles and investing with a rational, long-term perspective, investors can sidestep the pitfalls of chasing hot trends. Number 5. Ignoring the power of patience. In today's fast-paced world, many investors seek quick profits and expect instant results. However, Warren Buffett and Charlie Munger emphasize the power of patience in investing. Patience allows investors to weather market volatility and hold on to quality investments even when they face short-term setbacks. The mistake of impatience often leads investors to panic sell during market downturns, missing out on potential future gains. Buffett and Munger believe in holding on to well-selected investments for years, even decades, to allow the power of compounding to work its magic. They argue that patience can turn a good investment into a great one over time. One of the most famous quotes from Warren Buffett is, "The stock market is designed to transfer money from the active to the patient." This highlights the notion that active trading and impulsive decision-making are detrimental to long-term investment success. Number 4. Overconfidence and excessive leverage. Overconfidence is a psychological bias that can lead investors to overestimate their abilities and take on excessive risk. Many investors believe they can consistently beat the market or make superior stock picks, often leading to overtrading and poor decision-making. Additionally, some investors use excessive leverage, borrowing money to amplify their investments, which can result in catastrophic losses if markets move against them. Warren Buffett and Charlie Munger advise against overconfidence and excessive leverage. They emphasize the importance of humility in investing and recognizing the inherent uncertainty in financial markets. Investors should avoid taking on more risk than they can comfortably bear, and should refrain from using excessive leverage that can lead to financial ruin in a downturn. A more prudent approach, according to Buffett and Munger, is to focus on risk-adjusted returns and to be aware of one's limitations. It's essential to build a diversified portfolio that can withstand market volatility without excessive risk-taking. Number 3. Neglecting the impact of fees and taxes. Fees and taxes can significantly erode an investor's returns over time, yet many investors overlook their impact. Warren Buffett and Charlie Munger stress the importance of minimizing investment costs to maximize long-term returns. High fees, such as those associated with actively managed mutual funds or investment advisors, can eat into investors' profits. Additionally, frequent buying and selling of assets can result in higher taxes, reducing the after-tax returns on investment. Buffett and Munger advocate for low-cost, tax-efficient investment strategies. This includes using low-cost index funds, which tend to have lower expense ratios than actively managed funds. They also suggest taking a long-term perspective, as long-term investments often qualify for more favorable tax treatment. By paying attention to fees and taxes and adopting a tax-efficient, low-cost investment strategy, investors can ensure that a more significant portion of their returns remain in their pockets over the long term. Number 2. Neglecting the importance of a margin of safety. A critical principle in Warren Buffett and Charlie Munger's investment philosophy is the concept of a margin of safety. This means that investors should only buy stocks when they are trading at a price significantly below their intrinsic value. In other words, investors should seek a substantial discount to the estimated worth of the company. Neglecting this margin of safety is a prevalent mistake. Some investors are drawn to stocks that have been performing well, often buying them at or near their all-time highs. However, this can leave investors vulnerable to price corrections or economic downturns. Without a margin of safety, investors have little room for error if their initial valuation of the company is overly optimistic. Buffett and Munger recommend conducting thorough research to determine a conservative estimate of a company's intrinsic value. Only when the market price is well below this value should an investor consider buying. This approach provides a cushion against unexpected adverse events and increases the likelihood of long-term success. Number 1. Emotions driving investment decisions. Perhaps one of the most significant mistakes investors make is allowing their emotions to drive their investment decisions. Emotions such as fear and greed can lead to impulsive buying and selling, often at the worst possible times. For example, during a market downturn, fear may drive investors to sell their investments at low prices out of panic. Conversely, during a bull market, greed can lead to FOMO, fear of missing out, causing investors to buy overvalued assets. Warren Buffett and Charlie Munger emphasize the importance of rational decision-making and maintaining emotional discipline in investing. They argue that it is essential to divorce emotions from investment choices and make decisions based on sound analysis and long-term goals. A classic example of this is Buffett's advice to be fearful when others are greedy and greedy when others are fearful. In other words, investors should take advantage of market opportunities when prices are low due to fear and exercise caution when the market is exuberant. To overcome emotional decision-making, Buffett and Munger recommend having a well-defined investment strategy and sticking to it. This strategy should be based on fundamental analysis and financial goals, not on emotional reactions to market movements. Additionally, having a trusted advisor or mentor can help investors avoid making impulsive decisions based on emotions. If you found this video helpful, please give it a thumbs up to show your support and appreciation. We will be back to you with another amazing video. Thanks for watching.